Hey, how's it going? My name is David. I'm the founder of Green Mountain Advisors. We're an alternative investments group that focuses on venture capital, private equity, emerging markets, special situations, and tail risk hedging. Over the past 8 years, I've done about $3 billion in annual transaction volume trading the derivatives markets. So I have a lot of experience in quantitative finance. I have a lot of experience in risk management, and my operating team together has had several 8 and even 9 figure exits on several startups, and our portfolio company today generates about 8 figures a year in revenue. So I'm here to help founders through a video series learn the common mistakes that we see constantly as investors and operators and help them avoid the mistakes that most founders are making, which kills their company. So let's get right into it. How do founders ruin their growth? What are the common mistakes we see? And most of the time, it's not sales. It's not a lack of product market fit, even though that is the number two contributor to why businesses fail. Most businesses fail because they run out of cash. They run out of cash. Sometimes they'll get outcompeted. Sometimes their business model doesn't work. Sometimes some new regulation comes out that completely wipes out the business. But most of the time, they run out of cash. And I would argue that all of these reasons below running out of cash contribute to running out of cash. So as an entrepreneur, your biggest focus should be on maintaining the cash balance in your business and maintaining a positive free cash flow number. Okay. But let's just assume that the market needs your government approved product or service. You're still going to probably fail because you're going to run out of cash, or your business model is flawed, or you have pricing issues. So optimizing your price in a way that can be sustainable is one of the biggest factors when it comes to keeping your company afloat. And in 2023, 82% of businesses that went under did so because of cash flow problems. So this is something that the whole market is struggling with. And sometimes it's a revenue issue, but we've seen companies grow to massive scales and then go out of business regardless. A more recent example has been Bench Accounting. This is an accounting tech-based venture capital-backed company. They went under with like $100 million in invested capital. So if a company that has product market fit is going under and they have $100 million of invested capital, I guarantee you cash flow is the biggest thing you need to be worrying about, because it doesn't matter how many investors you have. It doesn't matter how much revenue you're making. What matters is how much you're keeping. So what is cash flow? Cash flow is the total amount of money coming in and out of your business that directly impacts your liquidity. It's not your profit, it's not your revenue, and it's not your bank balance. It's more so an aggregate of all three. Your cash flow is the difference measured on a certain period between period B and period A. So if we're in February and last month was January, your free cash flow would be the difference in net income plus whatever cash you had left over. That is your free cash flow. It's the most important number in your business, and it's grossly overlooked by a lot of starting founders. But did you know that 90% of startups have an accountant? When we saw that statistic, we said, okay, what is going on? Why are startups going out of business at rapid rates? Only 1 out of 10 startups end up succeeding, right? And 90% of them have an accountant. Shouldn't their accountant be telling them about their cash flow problems? If everyone has a bookkeeper, why is there a cash flow problem? Okay, let's assume you have product market fit. We're only talking about businesses where the market actually needs your product or service. You're still running into cash flow problems. So what is going on? And it's because your accountants are not your strategists. Businesses are left with numbers that don't mean anything to them. There's no planning for the future. There's no contingency planning. Everyone is just hoping for the best. And it's because accountants focus on compliance, not strategy. Only 39% of businesses have ever even drafted a budget. 39%. I think that's a contributing factor to why businesses are going out of business, okay? But imagine you don't have to rely on old financial statements to make future business decisions. Imagine you know what every single month in the next year, 2 years, or 5 years looks like because you've built out your future plan. Now there's no time delay from your bookkeeper or accountant. You don't really care what last month's numbers were because you already know how to make capital allocation decisions going out for the next 12 months. This is a huge competitive advantage that many small businesses and startups overlook. So what happens when you don't have a budget? Well, typically what we find is founders start overpaying on taxes and they rely on tax refunds. And this is such an inefficient strategy because your business is the best tax-free vehicle to build long-term wealth. Founders will misjudge their cash flow and their company's health because they're getting delayed financial insights from their accountant or bookkeeper instead of having a forward-looking plan. Your operations and your growth ultimately end up drying up. So as professional investors, how do we come into a company, whether it be our portfolio company or our client company, and do a forced appreciation where we add value to the business immediately and end this feast or famine cycle? The first thing we do is bring on a professional management team. Either it's us internally working with our founders, or we bring on a fractional CFO or COO. They need to be able to understand the gap between the current financials and the current operating procedures and how we want to bridge that gap so that they're working side by side with each other. Then we redefine the financial statements of the company. Because what you traditionally see with a lot of businesses is the accountant will prepare something in QuickBooks where you have your revenue, your cost of goods sold, some variable expenses, and then your net income. But none of that actually helps you scale the company. And what we do is we redefine the line items of the business so that we can actually see, okay, what are our direct costs? What are our indirect costs? How do we improve the sales team's efficiency? How do we improve management's efficiency? So we set up these benchmarks and then we try to beat those benchmarks over the next 12 months. But the only way to beat those benchmarks is by setting up a budget. So we have this baseline scenario for where we think the business is going over the next 12 to 36 months. And then what we do is we set up two projections. We have a best case scenario and a worst case scenario. And what that does is it immediately quantifies the risk associated with your business so that we have plans just in case something goes wrong or in case we do so well that we need to push it again. And after that, we set up rolling quarterly forecasts with our companies so that we know, okay, as things are changing, are we in line with our budget? Are we in line with our projections? Are we beating them? By how much? By how little? How do we correct it? And the only way to correct these issues or to improve on what's already working is by redefining our KPIs. And that means tying them to our financial statements. It means figuring out what are the core drivers of our business and how do they impact our financials? How do they impact our free cash flow? How do they impact our return on invested capital? These are numbers that investors and lenders will want to know, and they'll want to see that you have a plan that you're beating or you're aligned with or you're losing and you're correcting to when you go and ask for money. Because a lot of founders just say, oh, I'm just going to go and raise capital and, I'll figure it out as I go. That's the worst way about going about it, right? What you'd rather do when you go to an investor or a lender is to say, hey, this was our plan. This is how we beat that plan. We need money to do this. We need money to do that. It's way different when it comes to sitting down with an institutional investor once you already have a budget, once you've already beaten certain benchmarks. It's a totally different conversation, and that's the types of conversations we have with our clients and our portfolio companies when it comes to representing them with investors or lenders. So you should save 10 to 20% of your revenue in the next 3 months if you implement this budget. Because we've saved our clients millions of dollars with these exercises, and time again, it's because money was slipping through the cracks. And founders just don't have the mental bandwidth at the end of the day to analyze what's going on. They're just trying to make more sales. And that might have gotten you to $50K a month, but it's not going to get you to $1 million a month. You need to have a concrete relationship between your back-end operations and your back-end financial procedures. It's a non-negotiable. So once again, remember, when you build your budget, it's just the starting point. You need to set up projections and rolling forecasts to monitor your business's performance. We need to see how you're doing because what gets measured gets managed. And this is where the role of your KPI waterfall matters the most. Because if I can segment every single function in my business between product, delivery, sales, and marketing, I know what my margin delta is going to look like. Everyone's so obsessed with rule of 40, but they don't realize that there are certain core drivers that make up your margins. They don't realize that a small change, right? Going from 2 to 3%, improving your product team, keeping your delivery team normal, and then improving your sales and marketing by 2% drops off your margin delta by a factor of 8%. So even though you had a stellar June, your July is terrible. So how do we reduce the variance? Well, it ties back into our budget and our projections. So having the relationship between your KPIs and your financial statements is how you win the game. Investors want to see fat margins and they want to see consistency. They want to see that you're improving. They want to see that you have a plan and you're beating that plan. They won't invest without that. And that's why solving the big thing, which is your free cash flow, will set you up for an easy business. By setting up the right financial operating procedures, setting up the right business infrastructure, your business will become an easier operation. It'll become more scalable. It'll mean more money, higher margins, and a more turnkey operation. So if you ever wanted to sell your company and make that exit to either private equity or another buyer, you can, because it's all built out. Anybody can go and market some product and bring in revenue, but not everybody can go and build a real company. And that's the difference between a small time operation and a massive multi-million, if not billion-dollar enterprise. And that's what we do. We scale businesses to get to that point where they're ready to make an exit. We bring on investors, we talk to lenders, we build out budgets, and we improve the operating infrastructure of your company. That's what we care about. That's where we make the most value creation happen. It's not just a revenue generating exercise. And a lot of founders get caught up in sales because once they have a sales system that works, it's comfortable. They just rely on making more revenue. They don't care about churn. They don't care about improving their benchmarks. They think, oh, if I improve my company by 10% in a year, that's great. But what if we did 30? What if we doubled your business? All of that depends on how well your operating procedures are set up. So if you'd like to discuss more on how we can go and help your business scale, feel free to book a call in the description below.